What if there was no Constitution of India? What if there was no government? What if there were no income tax authorities? What if there was no penalty for tax evasion? Do you think there would have been less willful tax evaders? A penalty is a punishment imposed on the taxpayer for being non compliant. Levy of penalty for concealment of income or furnishing inaccurate particulars of income has always been a matter of litigation between the department and the assessee. The discretion regarding quantum of penalty left a scope for corruption. The scope of such provisions was always a subject matter of litigation. With a view to reduce litigation and remove the discretion of tax authorities, the Finance Act 2016 had substituted the provisions of Section 271(1)(c) and inserted Section 270(a) in the Income Tax Act 1961. The provisions of Section 270(a) have been introduced with a view to rationalize the penalty provisions and bring objectivity, certainty, and clarity in the penalty provisions.
At present, the income tax officer has a discretion to levy penalty at rupees 100% to 300% of the tax sought to be evaded. I propose to modify the entire scheme of penalty by providing a different categories of misdemeanors with graded penalty and therefore substantially reducing the discretionary power of the tax officer.
Section 270(a) provides for a levy of penalty for underreporting of income and misreporting of income. Plus, the Act has also defined the circumstances which shall be classified as underreporting or misreporting. Subsection 1 to the said section gives an authority to the assessing officer, CIT appeals, principal CIT and CIT to direct any person who has underreported his income during any proceedings to pay penalty in addition to tax on such underreported income. Such person shall be liable for 50% penalty on an amount of tax payable on such underreported income. Subsection 8 states that where an underreported income is in consequence of any misreporting by any person, such person shall be liable to pay 200% penalty on an amount of tax payable on such underreported income. Thus, it can be seen that misreporting of income has more dire consequences, which means that misreporting shall broadly cover cases where the assessee has knowingly withheld his income. Now, when is income said to be underreported? Number 1. In cases where return is filed, the income assessed is greater than the income determined in return processed under Section 143(1)(a, underreported is said to have taken place. Number 2, when no return of income has been furnished, the income assessed is greater than the maximum amount not chargeable to tax. Number 3, in case of reassessments, the income reassessed is greater than the income assessed or reassessed immediately before such reassessment. Fourthly, the income assessed or reassessed has the effect of reducing the loss or converting such loss into income. In simple words, if there is a difference between the income reported by the assessee and the income assessed by the authorities, the same will be treated as underreported of income. Now let's discuss what is underreported of income and how can we calculate tax on the same. Situation 1. In case where return is filed, amount of underreported income is the difference between amount of income assessed and return processed. Amount of tax thereon is tax on underreported income plus income determined under Section 143(1)(a minus tax on income determined under Section 143(1)(a. Situation 2. Where return is not filed and the assessee is a company, firm or local authority. Amount of underreported income is the amount of income assessed and tax thereon is tax on underreported income. Situation 3. In case where return is not filed and the assessee is an individual or HUF, amount of underreported income is amount of income assessed minus the maximum amount not chargeable to tax. Tax thereon is tax on underreported income plus the maximum amount not chargeable to tax. Situation 4. In case of reassessments, amount of underreported income is the difference between the amount of income reassessed and income assessed in preceding order. Tax thereon is tax on underreported income plus income assessed in preceding order minus the tax income assessed in preceding order. Situation 5. In case where returned income is a loss and on assessment, loss is reduced. Loss assessed or income minus loss as per section 143(1)(a) is amount of underreported income, and tax on underreported income is the tax thereon. So friends, it can be well stated that tax on underreported income is the difference between tax on assessed income and tax on reported income. Moving on to subsection 6. Subsection 6 provides that in specified cases, even where additions are made, the same shall not be considered as underreported income. 5 exclusions are as follows. Number 1. The amount of income in respect of which the assessee offers an explanation and the AO is satisfied that the explanation is bona fide and the assessee has disclosed all material facts to substantiate the explanation offered. Clause B. If the amount of underreported income is estimated, prima facie it seeks to illustrate additions based on estimation of gross profit as against declared profits without rejecting books of accounts and without finding that the audited financial statements of the assessee are not true and correct. In such a case, the difference attributable to estimated amount of gross profit can be excluded from the underreported income. Clause C. If an assessee estimated an amount in respect of a claim or disallowance, such claim is reduced or disallowance is increased in the assessment, the assessee has disclosed all the material facts to the addition or disallowance, then such difference is the estimate shall not be considered as amount of underreported income. Clause D. If addition is made to the total income returned on account of adjustment in arm's length price determined by the transfer pricing officer, the assessee has maintained information and documents prescribed under section 92D of the Act. The assessee has declared the international transaction under Chapter 10 and the assessee has disclosed all material facts relating to the transaction, then addition will not be charged as underreported income. Lastly, Section 271(a)(b) levies penalty on undisclosed income found during search. Cases which are covered under Section 271(a)(b) shall not be covered here. Generally, it can be said that misreporting implies a wrong reporting to mean a deliberate action with a view to achieve a result. In the context, reduce the total income liable to tax and accordingly the tax. The section prescribes 6 circumstances in which it could be said that underreported income amounts to misreporting of income. Clause A is misrepresentation or suppression of facts. For example, short-term capital gains shown as long-term capital gains to claim lower rate of tax. Next comes failure to record investments in the books of accounts. Number 3 is claim of expenditure not substantiated by any evidence. Fourthly, recording of any false entry in the books of account. Subsequently, failure to record any receipt in books of accounts having a bearing on total income. And the last is failure to report an international transaction. With effect from 1st April 2017, inserted a new Section 270(a) along with Section 270(a) in the Act empowering the AO to grant immunity from imposition of penalty under Section 270(a) of the Act, as well as initiation of prosecution proceedings under Section 276(c) and 276(c) of the Act on certain terms and conditions. The tax and interest as demanded as per the assessment or reassessment are paid within the time specified in the notice of demand issued under Section 156 of the Act, and the assessee does not file any appeal against the order of assessment or reassessment. The assessee can make an application in the prescribed form, that is, form number 68, within 1 month from the end of the month in which assessment order under Section 143(3) of the Act or reassessment order under Section 147 of the Act is received. It is important to note here that this immunity can be availed only in situations where the underreporting is not, I repeat, not in consequence to misreporting. Thus, if your actions falls under the clauses of misreporting, there is no escaping penalty of 200%. Moving on to our next section, section 271 AAB. To unearth the undisclosed income, tax authorities generally conduct search at the premises of the taxpayer. Section 132 provides the circumstances in which the tax authorities can initiate a search. If a search has been initiated and any undisclosed income is unearthed in the search, then penalty can be levied under section 271 AAB. This section is attracted only if few conditions are satisfied. These are: search must have been conducted on the assessee. This is a very important point based on which courts have ruled that in cases where proceedings under section 153C were initiated, those cannot be covered in section 271 AAB, as no such proceedings were initiated on those assessees. Number 2 is section 271 AAB 1A is attracted in cases where search have been initiated on or after 15 December 2016. Lastly, the previous year must qualify as specified previous year as defined in the section to attract 271 AAB. Now, what is specified previous year? Specified previous year means the previous year which has ended before the search and the due date of filing of return for such year has not expired till the date of search, and the return has not been filed by the assessee before the search with respect to such previous year. To simplify, say for example, if the search is conducted on say 15th June 2020, financial year 1920 shall be specified previous year, assuming that the return for financial year 1920 has not been filed till 15th June 2020. The year in which search is conducted. Thus, in our example, there shall be two specified previous year, one financial year 1920 and second financial year 2021. That is the year in which search was conducted. The department must unearth your undisclosed income during search on which penalty is to be levied. Any income which is found during the search proceeding, whether during investigation or during assessment, the same shall be treated as your undisclosed income for the purpose of this section, and penalty shall be levied on the same. The section 271 AAB specified two rates of levy of penalty, which are 30% and 60% of undisclosed income. I would like to draw your attention here that the penalty rate is applied on undisclosed income and not taxed as that was in section 270A. 30% penalty is levied in those cases where the assessee admits the undisclosed income, substantiates the manner in which it was derived, and on or before the specified date pays the tax together with interest thereon and furnishes the return of income for the specified previous year, declaring such undisclosed income. Specified date here means due date of filing of return. And 60% of penalty shall be levied in any other case. Here I would like to point out that substantiation of income disclosed is very important. Merely saying in the statement that I had X amount of income will not suffice, and you will not be able to satisfy the second condition for levy of 30% penalty, and the assessing officer will rather go for levy of 60%. They say drafting is an art. If that statement is of any value, then it is seen here. The assessee must be cautious enough about his disclosures and manner of disclosures of unaccounted income, as the manner and way in which assessee makes the declarations, since it decides the fate of the assessee as regards penal provisions. The disclosure statement plays a huge role during assessment proceedings, and the same should be meticulously drafted after taking proper professional opinions. Now, the last one in today's presentation is Section 271 AAC. Section 271 AAC of the Income Tax Act, inserted with effect from assessment year 2017-18 by Taxation Laws Act 2016, empowers assessing officer to levy penalty if any addition is made under Section 68, Section 69, Section 69A, Section 69B, Section 69C, and Section 69D. The income under these sections is charged to tax under Section 115BBE. The quantum of penalty will be 10% of the tax payable under Clause 1 of subsection 1 of Section 115BBE, which is 60% of the income. I will give you a brief of what these specified sections in 115BB are. Section 68. Section 68 specifies that if any sum is credited in the books of the assessee for a particular previous year, and the assessee offers no explanation about the nature and source of the credit, or if the explanation offered by the assessee is found to be unsatisfactory by the assessing officer, the credit amount will be taxable as the income of the assessee for the particular year. Section 69. If the taxpayer has made any investments in the financial year immediately preceding the assessment year, which is not recorded in the books of accounts, and the assessee abstains from making any explanation about the nature and source of investments, or the explanation offered by him is found to be unsatisfactory, the value of investments may be deemed to be the income of the assessee for the particular financial year. Section 69A. If in any financial year the assessee is found to be the owner of any money, bullion, jewelry, or valuable article maintained by him for any source of income, and the assessee has neither recorded the same in books of accounts nor has offered any explanation on the nature and source of its acquisition, the specified valuables may be deemed to be the income of the assessee for the particular financial year. Moving on to Section 69B. Section 69B of the Income Tax Act provides that if in a given financial year the assessee had made investments or is found to be the owner of any bullion, jewelry, or any valuable article, and the assessing officer opines that the amount expended on the same exceeds the amount specified in the books of account maintained by the assessee, the excess amount will be considered as the amount of income of the assessee for the particular financial year. Section 69C. While the previously discussed sections deal with the income of the assessee, Section 69C covers expenditure. The rules under this section stipulates that if the assessee has incurred any expenditure and offers no explanation for the same, or if the assessee offers an explanation which isn't satisfactory in the eyes of the assessing officer, the amount covered by such expenditure or part thereof will be deemed to be the income of the assessee for the particular financial year. Section 69D. If any amount is borrowed on a hundi form, or any amount due thereon is repaid to any person otherwise than through an account paid check drawn on a bank, the amount so borrowed or repaid shall be deemed to be the income of the person borrowing or repaying the amount for the particular year. In order to curb the practice of laundering of unaccounted money, it was proposed to tax the unexplained credits, money, investment, expenditure, etc. Section 69B, C, D, 68, 69 and 69A at the rate of 60% plus 25% surcharge and cess as applicable. It is also provided here that no deduction in respect of any expenditure or allowance shall be allowed to the assessee under any provision of the Act in computing deemed income under the said sections. This section was amended and a huge tax rate was provided during the time of demonetization. The government intentionally wants this to be harsh. The provisions of this section are notwithstanding anything contained in this Act other than provisions of Section 271AA(b). In other words, where penalty is levied under Section 271AA(b), penalty under this section may also be levied. In other words, if a search is conducted in the premises of the assessee and he is found to have income chargeable to tax under Section 115BBE, he would end up paying whopping 138% plus interest separately. That would all be for today. For major penalties under the Income Tax Act, stay home, stay safe. Thank you.